As of 9:40 a.m. Eastern Time, Navitas Semiconductor, ticker NVTS, is trading at $8.20, and it is getting hit hard, down about 5% on the session, a drop of roughly 43 cents from its last close. This isn't just a random dip or sector-wide pressure. What you are seeing right now is the market trying to process a massive, fundamental disconnect between this company's story and its actual performance. This 5% drop is a symptom of a much larger battle between expectation and a very harsh reality. If you're holding this stock or thinking about buying this dip, you absolutely need to understand what is happening under the hood, because the popular narrative is miles apart from the financial facts. The expectation, the story that has been driving this stock, is incredibly compelling. For the last 6 months, Navitas has been presented as the ultimate picks and shovels play for the artificial intelligence build-out. The narrative is that while everyone is focused on Nvidia stock, the real opportunity is in the infrastructure, and Navitas makes the highly specialized power chips, Gallium Nitride, or GaN, and Silicon Carbide, or SiC, that are essential for the next generation of power-hungry AI data centers. This story got a massive boost back in May when Nvidia itself named Navitas as a partner for its new 800-volt AI factory architecture. The stock exploded. We saw a 164% gain in a single day. Over a 6-month period, it was up over 700%. For anyone doing online investing or using a platform like the Robinhood app, NVTS looked like the next rocket ship. It was the story everyone wanted to believe, a small-cap supplier poised to become a critical component for the biggest theme in the market. Then, on November 3rd, reality arrived, and it was brutal. Navitas reported its third quarter 2025 earnings, and it was a complete disaster. This is the insight that the market is struggling with. The expectation was AI-fueled growth. The reality was a 53% collapse in year-over-year revenue. Revenue didn't just miss expectations, it plummeted to just $10.1 million. The company also missed on the bottom line, posting a loss of 9 cents per share when analysts were looking for a 5 cents loss. But it didn't stop there. Management then issued guidance for the fourth quarter, and they are projecting revenue of just $7 million. This isn't a slowdown, it's a full-blown collapse of their current business. This is where the story completely shatters. How can you be the key to the AI future when your revenue is not only not growing, but falling by more than half? This is what's causing the volatility you see today. The stock is now a war zone. On one side, you have the story-driven retail traders, perhaps doing Robinhood stock trading or using SoFi stocks, who see the Nvidia partnership and are buying every dip. On the other side, you have institutional investors, the clients of Fidelity Wealth Management or those using complex interactive brokers platforms, who read the earnings report, saw the 53% revenue drop, and are selling. And then you have the short sellers. The short interest on Navitas is staggering. At last check, over 30% of the entire float is sold short. That is an enormous, combustible position. It means for every 3 shares available to trade, 1 is a bet that the price will fall. This makes the stock incredibly volatile, prone to massive short squeezes on any good news and violent collapses on any bad news. Today, the bad news is winning. Management, of course, has a new story to explain this. The new CEO, Chris Alexandra, has dubbed this Navitas 2.0. The official line is that this revenue collapse is intentional. They claim they are deprioritizing their old, low-margin business, which was primarily making GaN chips for mobile phone fast chargers in China. They're pivoting the entire company toward these high-power markets: AI data centers, electric vehicles, and energy infrastructure. Management is telling investors that Q4 2025, with its $7 million guidance, will be the bottom, and that 2026 will be a transition year. They are essentially asking the market to ignore the catastrophic numbers today and trust them that the real revenue, the AI revenue, will show up eventually. This is a very, very big ask. This is where investment help is crucial. A simple intelligent portfolio or a robo-advisor like Schwab Intelligent Portfolios might just see semiconductor or AI and buy it. But a deeper look, a self-investing approach, reveals the true risk. The company is burning through $10 to $11 million per quarter. While they have a healthy $150 million in cash and no debt, we have to ask where that cash came from. It came from massive shareholder dilution. Since this company went public via a SPAC in 2021, the outstanding share count has increased by over 580%. They've been funding their operations by selling new stock, which waters down the value of every existing share. This isn't what you see with a healthy growing company like Apple stock, or even a giant like Tesla stock. And then there's the insider activity. In the last quarter, insiders sold 2.8 million shares worth over $17 million. This includes the chief financial officer and a company director. This is a massive red flag. It's one thing for the CEO to sell Navitas 2.0 on an earnings call, but it's another thing entirely different when your own financial chief is selling a large chunk of his stock right after that new strategy is announced. This is the kind of data you look for on a Fidelity trading platform or an Interactive Brokers account. It's the data that often tells a truer story than the press release. So, what exactly does Navitas do? They are a pure play on wide bandgap semiconductors. Forget old silicon. The future of high-power electronics is gallium nitride, or GaN, and silicon carbide, or SiC. These materials are just fundamentally better. They can handle higher voltages, switch faster, and waste far less energy as heat. This means you can build power supplies that are dramatically smaller, lighter, and more efficient. This is exactly what AI data centers need. An AI server rack can consume as much power as dozens of homes. You can't use old, inefficient silicon technology. You need GaN and SiC to manage that power. Navitas designs these chips. It's GaN-fast and GaN-safe ICs, and this technology is legitimately good. Their partnership with Nvidia is real. The problem is that this is an incredibly difficult, competitive market. They are not alone. They are competing against absolute giants like Infineon, Texas Instruments, and Wolfspeed. Companies with decades of manufacturing experience and deep customer relationships. Navitas is a small company trying to fight its way into a market of titans, all while its legacy business evaporates. This brings us to the analyst ratings, which are a perfect reflection of this chaos. On one hand, you have bullish firms like Needham, which just reiterated a $13 price target. They completely buy the Navitas 2.0 story and believe the AI data center opportunity will create a revenue explosion in 2027 and beyond. On the other hand, the consensus price target from most analysts is closer to $6 or $6.5, with some as low as $4.4. Many analysts at major banks, the ones who create the Fidelity ETFs and Fidelity mutual funds that might hold this stock, are effectively saying the stock is significantly overvalued and are rating it a hold or sell. They see the 53% revenue drop, the $7 million guidance, and the massive competition, and conclude that the risk is far too high. So what happens from here? The future outlook is a binary bet. The bull case, the expectation, is that management is telling the truth. The $7 million quarter is the absolute trough. The China mobile business is gone, and from here, every bit of new revenue will be high-margin AI and EV business. The 30% short interest will be forced to cover as the revenue slowly ticks up through 2026, and when the big data center orders hit in 2027, the stock will rocket past its old highs. In this scenario, today's $8.20 price is a fantastic entry point for a long-term hold in your individual brokerage account. The bear case is much darker. The Navitas 2.0 pivot is a desperate Hail Mary because their core business was destroyed by competition in China. The new high-power markets are too crowded, and the giants like Infineon will crush them on price and scale.